This is something we do mention this term constantly, so I thought it might be nice just to specifically describe what it is,
Mhm.
and that's what a tail event is and why they're so important.
Yeah. So, if you've taken a statistics class, we're talking about basically the distribution of returns from your asset. There's something called the empirical rule there, which is basically referring to the first three standard deviations of the distribution of those returns on the positive and the negative side. So, the first standard deviation represents about 65% of the data, and then it's 95%, and then it's 99.7% of the data once you get to the third standard deviation. Now, the interesting thing about markets is that they are not normally distributed. So they tend to have kind of a positive skew. The markets tend to go up more than they go down. We know that's true. But the tail events are really random and they can show up in weird locations and oftentimes represent what we would call Six Sigma events, which a Six Sigma event is basically six standard deviations from the normal returns we would see from the asset, like the S&P 500. So what makes investing very difficult is trying to capture all those probabilities as best we can. But because they're not normally distributed and because they are sometimes very random, even when we've built a model that tries to capture that volatility, a different type of volatility can show up than we accounted for. A bigger sell-off occurs than what we accounted for. A larger event occurs, or as the phrase I've heard you use before, Tom, is a melting up situation might occur, where on the positive side of that distribution, there might be a bigger event that leads to a huge upside that you missed out on, or maybe you were short the market and it just went against you in a really significant way. So those tail events are something that you can try to account for through through various types of strategies. Some people try short side strategies, hedging with futures. Sometimes you can use options contracts in order to try to, buy deep out of the money puts and account for some of those tail events that no one's expecting, largely kind of trying to bank on the possibility that there's a panic sell in the market that was unaccounted for in most people's view of the market, which is, again, I think I talk a lot about volatility. Oftentimes, I think people's trading activity represents a very recent reflection of where volatility lies. And they don't tend to look at the whole picture. But even when you look at the whole picture, you're probably still not accounting for what can still happen in the future. And that's kind of the point of tail events. We don't expect them to happen, but they can still happen. And I think you've mentioned before, Tom, they happen more often than we realize.
Yeah, one of the fun things about tail events is that because especially markets, they're a dynamic system that are interrelated, and so sometimes or oftentimes a tail event that happens in one place will then make another tail event that was also improbable more likely to occur, and then you can have this cascading effect. A classic example for this was the COVID one, which I got completely caught up in, where you had this event, this global pandemic. So that's a tail event. Then the market drops, but because of the gamma within the market, the way that the dealers have to position themselves, there's this exacerbated move towards the downside because as these put options became more valuable, the dealers had to then hedge their positions more and more and more, and then you head down. But then you get to a point, so then you go, well, that should just continue. It should just keep falling down. But then there's the response function of the Federal Reserve, of the government, where they go, well, lockdown, let's start pumping money in, give people checks, do whatever necessary in order to keep the economy going, and then that liquidity comes in, which itself is a tail event as well. Trillions of dollars suddenly being pumped to the market, that's not in our back test. So then it's just this one after the next after the next after the next. It's like flipping heads on a coin 500 times in a row. It's improbable, but if it does happen and you bet against that, well, now you are in a heap of trouble. And then we had that whole V and then up to all-time highs during a lockdown of the world,
Which I
markets
would
making
I
all-time
would
highs.
count that as another tail event, right? It's a
Another tail
positive
event.
tail event that no one expected to happen.
Exactly.
Hmm.
And so then you have the wealth effect that happens after that because
Hmm.
the markets went up and then more people went in, and now we deal with inflation, which we haven't had for um, or core inflation that we haven't had for since the 70s. So it's just these chains of things because all these systems are connected to each other. The reason I mention this is that that's why if you understand tail events as actually fat tailed, that they happen actually more often than you think, that's where sometimes as a retail trader you can actually get an edge,
Mhm.
right? You can try to find some sort of edge, or as Kim Carson talks about it, a lean. Maybe you don't have an edge, but then you notice some sort of dynamic happening and you can lean into it because you can imagine it actually goes further than you actually think, and that's a way of capitalizing on these things. But if you
I like
only
that.
think of, yeah, if you only think about the trend and you never really account, you never see those tail events as I should expect them to happen, and to take advantage of them when they happen. So, for example, like the
Mhm.
GameStop, the meme praise was a tail event. What is this? The retail market got together in order to squeeze
Again,
hedge funds out of a position, like,
twice.
and then it happened twice
Yeah.
exactly. And it's so I remember when it happened the first time, I go, well, no, this is too incredible. Like I
Mhm.
shouldn't pay attention to it. But then if you use those tail events as you think to yourself, well, that's going to cause a ripple of volatility that'll spread through these dynamic systems, then you know there's probably going to be other things. Just like the earthquake over here might cause a tsunami over there. And so I completely discounted the tsunami because I just looked at the earthquake and I go, oh, that's crazy. Not realizing, oh no, there's a wave now. I can actually surf.
Yep.
I discounted it. So um, understanding fat tails, recognizing them, and realizing that they are not necessarily something to be avoided, but to be used as part and parcel of your trading experience can be super valuable and very rewarding to study.
Yeah, I totally agree. I think maybe this week's events have actually been sort of an example of what I try to pay attention to, especially in low volatility environments. When the VIX gets down to 11, 12, that's like really, really low environment. That's usually the calm before the storm. And we saw the VIX rip up to almost 20 yesterday. I'm not sure. I didn't even look where it is today. But those types of changes are sea changes that can create an echo in markets, in my mind, where that event where you see a sell off, you might expect there to be some form of a sell off because we started breaching technicals, we started breaching some crossovers, and so on and so forth. But I don't think we expected this big of a sell off, which is why I like not just tail event analysis, but really trend following in general. This is the reversal of a trend and the beginning of a new trend, and it has some strength behind it that's coming from the market. And this is a great opportunity to ride that wave once you see it coming in. It feels a little bit like being a surfer out on the waves, and you're just sitting there, and there's calm. It's just a calm environment, and you've got 60 guys out there on their boards, and they're just sitting there on their boards waiting for something to happen. And if you're out there waiting on your board and you've got the idea of exactly how you're gonna surf, then when that wave comes, you're ready for it. So
That's exactly right. Peter here says, I'm proud of myself for not making jokes about tail events, which sounds like something out of a seduction seminar.
seduction seminar.
Fair, fair
I
enough.
need to talk to my wife about tail events.